morning. We are getting so close to wrapping up the trimester in personal finance, and we've talked a lot about credit and borrowing money and calculating interest and banking and savings accounts. But we are finally moving on to the thing that I find most fun and exciting and most important in my personal life as well, which is investing. This is the really good stuff in my opinion. So we are going to talk first about what is investment and why should you invest. So let's define it first. Investing is the use of long-term money to earn a financial return. So savings really is a very short-term focus. Investing is a long-term focus. So savings is for a short period of time. Investing is for a long period of time. And it's how you can really start to strengthen your financial position and build your wealth. And this third thing is important because not only then are you getting a paycheck every pay period, which is nice to have as well, but then you can also get another source of income by getting returns of dividends, interest, other types of things related to investments. So your money's working for you. So there are three primary reasons. That last slide said, why do we invest? There's three reasons. There's to beat inflation, there's to build your wealth, and because it's fun to do. So let's first talk about inflation, and hopefully you guys know this, but inflation's the rise in the general level prices, and it impacts and hurts your purchasing power. Because as prices rise, then it takes more money to buy the same goods and services. So let's say that I buy every month, 3 gallons of milk. I fill up my car with 20 gallons of gas 5 times that month, and I rent an apartment. And let's say that all costs me $1,100. Well, inflation would say that next month that may cost me $1,101, and the month after that $1,105, and the month after that $1,106. So buying those exact same things ends up costing more. So I've lost purchasing power, which is what inflation is. So investing can help me. If I can get a return on my money higher than that inflation, then I can still build wealth. So there is this thing called a rule of 72, and I think it is crucial that you understand what this rule of 72 is. We have Albert Einstein to thank for this. He came up with a mathematical equation to compute compounding interest, and as you would expect, that equation was somewhat difficult and complex and too hard. So what the rule of 72 was him coming up with a technique for estimating the number of years required to double your money at a given rate of return. So it is a really quick way to figure out, if I invest $100, how many years will it take to double if I'm getting 6% interest? Or also it will help me figure out, if I want my money to double from $100 to $200, what rate of return do I need to get if I want that to double in 10 years? So it's just a really quick way to do that. The key is it can be applied to both when I invest money as well as if I borrow money. So if I'm investing, how long does it take to double from $100 to $200? But if I have debt, and they're charging me interest, how long for it to double? So it can go on both sides of that, which is key. So we have a video that I'm going to want you to watch on it, and please do. It's a very good video to explain it, but it talks through kind of the calculation. So here on the screen we have the equation. It's really twofold. I can do either 72 divided by the number of years to figure out what interest rate I need to get on an investment for it to double in those number of years. Or I can do 72 divided by the interest rate to figure out how many years it's going to take for that investment to double. So there's a few key things that I would make sure that I know when I do this calculation. And again, I'll show you examples and we'll work through this, but it's important that you realize it's only an approximation. The interest rate is assumed to stay constant. So if I'm talking over 12 years wanting that to double, I'm always getting 6%. That interest rate never changes in this approximation. There's no additional investment that got made or debt taken on, payments against that debt. So if it's I invested $300, that's it for the whole period. I'm not investing more money in. And then the fourth thing is it assumes that interest is being reinvested to earn more, and it totally ignores all tax deductions or tax-related implications. So again, it is quick, it is easy, it is an approximation. So the second reason that we invest is to increase our wealth. And I'm going to go ahead and put all of the bullets up there, but key things to think about. It's easier to accumulate wealth if I invest than just put my money under the mattress or in a savings account. And then these last two bullets are kind of explaining that it's a win-win. If I invest in a company, it helps that business by selling their products and service. It's a win for them. And if I invest in that company, in their stocks or bonds, I get dividends or interest or some sort of return. So it's a win for me too. So investing is a win-win for both parties typically. It can go the other way for sure. And then the last reason is it's just fun and challenging. So we get to make choices. You guys are going to get some opportunities to do that in a few projects. And you can gain experience, figure this all out, or you can just have someone else do it for you if you would prefer to have someone else do that for you. So it is definitely a way to beat inflation, build wealth, and it can be very fun and challenging. So next we talk about stages of investing, and there's these 5 stages, and we're not going to hit this hard at all, but there is a figure 16.1 that's in your book. And these first 3 are kind of for you guys, the most important ones. So you've budgeted, you've done all that, but now you have some money or some savings. You can put it in a put and take account, which is really just saying that I put my check in and I take money out to pay bills. And this is really looking at a 3 to 6 month time horizon. It's hard to see that, I know. And you put your net pay into this fund, basically. The second one here is initial investing. And you've typically not got a lot to lose at this point. So when you first start out, you maybe have $100 or $200, $300 that you're willing to put into something and not willing to lose, because you don't have that much to lose at that point. And then a systematic investing tends to be once I'm more stable in a career that I'm going to start to have a certain amount every single month, and I'll start to long range plan more and do retirement. And this is really down the road later in your life, well after college typically, that someone will start considering doing these. So when you first have some money, that you're not spending it all to pay your bills, and then it's a little amount here and there, not regular. Systematic says I'm going to do it often. So we've talked about the 3 reasons why you invest and the stages of investing. So then let's talk about portfolios and risk. So a portfolio is a collection of your investments. So it's the stocks you own, the bonds you own, any ETFs, mutual funds, all of your investments. So that is a portfolio, and we'll be talking about that. So it's important that you understand the role of risk. So investment risk, investing risk, the chance that the investment's value will decrease. So when we do investing, we of course are hoping that the investment value of the stock, of the bond, whatever it is, goes up. But there is risk that it will go down, and it's important people get that. This next bullet is crucial that we're going to talk right here. This is the cardinal rule of investing. If you don't remember anything else we talk about on this right now, at least understand this. The greater the risk you are willing to take, the greater the return. Increased risk, increased return potential. That return can be positive or negative, right? It can be a huge return or a huge loss, but as risk goes up, so does return. As risk goes down, so do your returns. So that is crucial that you understand that. A safe investment then has little risk and little return. And we're all different. Some are more willing to take risk than others. So we will talk about that. So we're all different, but there is no doubt risk exists with every single investment. So what helps us lower risk is diversification. And diversification is spreading the risk among lots of different types of investments. That reduces my overall risk because then all my choices aren't going to be poor at the same time. So if one doesn't do well, the others will likely make up so that they're kind of just evening out. And right now during this COVID-19 thing, I think you can definitely even see this, that if you have a strong portfolio with lots of different types of investments with different type of risk, you still are weathering this storm pretty well, because if I have stocks in the airline industry, I'm probably stinking right now. Things are not going well. There's a low return. But if I also, in my portfolio, have stocks maybe in technology firms like Google is doing really well, or pharmaceutical companies, or places like that, then those are going to offset and do well during this uncertain, scary time with COVID. So diversification is all about trying to get stocks, bonds, all these investments of different risks so that they just kind of offset and balance each other and just kind of steadily help you build your wealth. So that's kind of the point of diversification. So there are lots of types of risk associated with investing risk, and they're listed here. I'm not going to go through them. They're beyond the scope of this class. Just know that if you would like, you can go to page 383 and 384 and learn more about what each of these are. And then next we're going to talk about investment strategies. And I'm going to do another quick video about that because, again, this is really cool and fun and awesome stuff, investments. So I don't want to hurry through that. So I'll do another quick video on investment strategies to wrap up section 1 of chapter 16.